Hello everyone, this is Kevin. In this video, I'm going to show you how to analyze oil and gas exploration and production companies using actual company documents and key industry metrics. If you are new to oil and gas investing or want to understand the fundamentals better, this is a great video for you. This is part one of a multi-part series, and we will begin by going over the most important documents and numbers to look at when evaluating these type of companies. Let's dive right into it. Before we dive into the numbers, let's talk about the three most important documents you need when analyzing company fundamentals. First are the conference call slides. These are presentation slides prepared by the company's management, and they give you a quick overview of the business each quarter. You will usually find key informations like revenue, profits, production growth, and future guidance, all laid out in an easy-to-read format. You can find them on the company's investor relations page, and they are usually posted before or during the earnings call. As an example here for Rain Energy, you can find the investor presentation slides here under presentations, and it will show you all the investor presentation slides. We have Super DUG Conference 2025 slides, Q1 2025 earnings call presentation slides, and so on. Next are the 10Q or 10K filings. These are official financial reports filed with the SEC. The 10Q is the quarterly report, and the 10K is the annual report. These documents go much deeper. They include financial statements, management's discussion of results, risk factors, and so on. You can either find them on SEC's EDGAR database or again on the company's investors relations site. Using Rain Energy as an example again, you can find that here under investors and SEC filings. Then they show you the 10Q. Or if you want more, you could just click this and you should be able to find 10K and other SEC filings here. The third one, and probably the most overlooked, is the conference call transcript. This is a written record of everything said during the company's earnings call, including what the CEO and CFO say and the Q&A with analysts. Why is this important? It's important because it helps you judge how honest and transparent management is. Are they delivering on what they promise? Are they open about challenges? I would suggest reading at least 3 years worth of transcripts to get a sense of how reliable the team really is. It can take a lot of time and it can be boring, but this is where you find the real insights most people miss. Sometimes the company will have these transcripts on their website's investor relation, but when they don't, you can get it from other websites. I personally like to use this website called capedge.com. If you go through these three things, the slides, the SEC filings, and the conference call transcripts, you already know more about the company than 95% of the investors out there. Now that we have covered the documents, let's move on to some oil and gas specific metrics you should watch. You can find all these numbers in the company's 10K SEC filing, which is their annual report. In this section, we will look at 1. How to understand production numbers. 2. How to read proved reserves. 3. What the reserve replacement ratio is. And 4. How to figure out how many years of production the company has left. First, let's talk about production. Companies usually report either their total annual production, daily production, or both. If they only give you daily numbers, just multiply that by 365 or 366 days if it's a leap year to get the annual production. So here for REI, they give us both the total annual production and daily production figures. From 2022 to 2024, they have been growing their production pretty aggressively. This company has been focused on growth for the past few years. However, this does not mean that they will continue this trajectory in the coming years. Management will usually tell you their plans for the coming years in the conference call slides or on the earnings call transcript. Therefore, it is extremely important to look at those two documents to understand their future outlooks. By looking at this granular breakdown of oil, natural gas, and natural gas liquid production, it tells us what type of energy the company primarily focuses on. One thing to keep in mind when you read these numbers is the units. Different companies use different units. Here you can see Rain Energy uses barrel for oils, MCF for natural gas, and barrels for natural gas liquids. And for total productions, it's using BOE. Here is the list of what each units mean. BBL refers to barrels, which is approximately 42 US gallons. BOE is the barrel of oil equivalent. It's a unit of energy that combines oil and natural gas volumes by converting the energy content of natural gas to an equivalent amount of energy in a barrel of oil. CF stands for cubic feet, and M means 1,000. Therefore, MCF means 1,000 cubic feet, and so on. Coming back to the total production page, to convert this natural gas number to BOE, you will have to divide this by 6. If you do the math, then Rain Energy is actually very oil focused. Their total production is about 67.6% with oil, 14.9% natural gas, and 17.5% natural gas liquids. Why does this matter? It matters a lot to us investors because with this, we will be able to determine which commodity price changes will impact them more than the others. Next, let's talk about proved reserves. What are proved reserves? It's basically the estimated quantities of oil, natural gas, and natural gas liquids that are expected to be recovered with reasonable certainty. There are two types. First is proved developed. These are already producing reserves or can start producing right away with existing wells. Second is the proved undeveloped reserves. These are reserves that are not drilled yet, but are expected to be developed soon based on a clear plan and economic logic. Why does proved reserves matter? It matters because the banks use it to determine how much a company can borrow, and us investors can use it to estimate fair value and future potential. You can usually find this in a company's annual 10K SEC filing. Normally, they don't include this in the quarterly filing, so you will have to look into the 10K. Now, let's talk about a useful metric called years of production remaining. This number tells us how many years a company can keep producing oil and gas based on its current reserve and its most recent annual production. It's extremely important because it gives us a clue about what the company might focus next. For example, if they only have a few years of reserve left, they will probably need to spend more money finding or buying new reserves. But if they have a lot of reserves, more than the industry average, they might focus more on growing production instead. To calculate this, just divide the total proved reserves by the company's total annual production. Here, for Rain Energy, there are around 134 million of BOE left, and their annual production is around 7.2 million. If you do the math, that results in 18.65 years, which is great because the industry average right now, it's around 10 years. So Rain is almost double that. Next, let's cover reserve replacement ratio, or RRR in short. This number basically tells you if the company is replacing what it produces. The formula is simple: reserves added divided by total production. If the ratio is 100%, they're replacing what they produce. Over 100%, they're growing its reserves. And below 100%, they are producing more than what they are adding into their reserves. So what counts as reserves added? Usually it includes new discoveries, extension of existing fields, revisions upward or downward of previous estimates, or even just simply by acquiring other company. A company may or may not report this number directly in their 10K. If they do, that's great. But if they don't, you can calculate this yourself. Just take the approved reserves added and divide it by the annual production. For example, here in Ring Energy's case, if you do the math, their reserves added was around 4.4 million in 2024. Their production, it's around 7.2. So if you do the math, this results in 0.61, which is around 61%. This is below 61%, which is bad in general. However, since this company has 18 years of production remaining left, and the industry average is currently around 10, it is totally fine for them to deplete reserves since they have so much additional. Why does reserve replacement ratio matters? It matters because oil companies cannot stay in business unless they're replacing what they take out of the ground. It is a key measurement for long-term sustainability. So those are the key production and reserve metrics that you can look at when analyzing oil and gas exploration and production companies. From production rates to reserve replacement ratio and years of production remaining. These numbers can help us investors understand whether the company is just holding steady or actively growing and securing its future. That wraps up this first video of this fundamental series. In the next parts of this series, I will be covering things like financial metrics, how companies use hedge to deal with price swings, how to value oil and gas companies, and many other important topics. If you find this helpful, don't forget to subscribe so you don't miss the rest of this series. Also, please give this video a like. It will really help me and support the channel. Thank you for watching. I'll see you in the next one.